What's up everybody, I am Jaspreet Singh, and over the last year or so, we have seen the housing market boom at pretty much the fastest rate ever, with low inventory and high demand pushing home prices up through the roof. But now with interest rates going up, we've been seeing mortgage rates grow at pretty much the fastest rate that we've ever seen, and this has naturally flipped the housing market because now the demand for people to go out and get a mortgage to buy a home has been dropping at some of the fastest rates we've ever seen. And as of today, it doesn't look like interest rates are going to be slowing down anytime soon. The reason why this is so significant is because housing affordability has dropped to essentially the lowest level ever, and it's very easy to understand this when we look at 2021 to now to potentially where we might be next year, because this home in 2021 might have sold for $500,000, and if you put down 20%, that would mean $100,000, and you could get a 2.5% 30-year fixed rate mortgage locked in, and this means that your monthly payments would be $1,580 a month just on your mortgage. We're not looking at property taxes, we're not looking at insurance. In 2022, between 2021 and 2022, we've seen home prices grow by just over 20%. So if we assume that home prices grew by only 20%, that means the same home with no additional modifications is going to cost you $600,000. So you're going to put down the same 20%, which would be $120,000. But now if you want to go and get a fixed rate 30-year mortgage, you're not paying 2.5%. You're hovering at close to 6.5%. This is about double where we were in the beginning of 2022, just 6 or 7 months ago. And so now this same home is going to cost you not $1,580 a month, but $3,000 a month on your mortgage if you get it at 6.5%. And this is not including now the higher property taxes that you're going to have to pay because the home is more valuable, and you're also going to have to pay a higher insurance rate because you're insuring a more expensive home, even though it's the exact same home as here. Now, if we fast forward to 2023, where what people are projecting of what's going to come in the future, everyone is saying that we can expect home prices to grow by another 5% or so over the next year, which means this home will be $630,000. Now, if you're going to put down the same 20%, that's $126,000. And at this rate, if the Fed stays true to fight inflation and they keep raising interest rates the way that they say that they will, well, we could see mortgage rates hit around 10% next year. And that means now your monthly mortgage payment is going to cost you around $4,400 on this exact same home, assuming no modifications. And now you also have the higher property taxes and the higher insurance on top of the higher mortgage payment. The reason why these numbers have been growing so significantly is because not only are you borrowing more dollars, but you have to borrow the dollars at a higher price. You have to pay more interest on these dollars. And if we assume the mortgage rates go up to 10%, if you can only afford a $3,000 monthly payment, well, that means the max that you can borrow at 10% is $350,000. In this instance, you're borrowing about $500,000. And if you want to afford a $1,600 mortgage or $1,580 mortgage, the max amount of dollars that you can borrow would be $180,000. Here, you could borrow $400,000 at the 2.5% to get a $1,580 mortgage, but at 10%, you can only borrow $180,000. Here, you could borrow $480,000, but at 10%, you can only borrow $350,000. This is why adjustable rate mortgages have been making a comeback, because people are looking for an alternative to get a lower mortgage rate again. Now, on the real estate investing side, this market has made it more difficult to be able to find a real estate investment property, but what you don't want to do if you're an investor is try to time the market and say, I'm not buying any more properties until X, Y, or Z happens. What you want to be doing is looking for the right opportunity in today's market, in any market, and that means understanding what your goals are. How much cash flow are you looking for? How much can you afford? And what are the types of returns that you're looking for? Now, obviously, the best way to invest in real estate is to own the actual property yourself. But if you're not willing or not able to or don't want to do that, but still want exposure to real estate, the next best thing for you would be to invest through something like our sponsor, Fundrise. Fundrise is a platform that allows you to get exposure to physical real estate. So if you have $1,000 or $5,000 and you want to invest in real estate, you can't go out and buy a whole property, but you can invest this money through Fundrise and get exposure to some of the best private market deals out there. I invest in physical real estate. I've also invested my own money into Fundrise. I made my first Fundrise investment in 2018, and since then, my investment portfolio has grown by about 38% through Fundrise. Now look, just like anything else, you're never guaranteed to make money when you invest your money. However, with Fundrise, you don't have to worry about all the headache that comes with real estate investing. You don't gotta manage tenants, you don't gotta manage the property, you don't gotta find the property, you just invest your money into a fund that gives you exposure to multiple different properties, and now you let the expert developers, the expert managers do their thing, and you just get your share of the profits. Plus, the really nice thing about Fundrise is you don't have to worry about trying to time the market in real estate because they have set up a dollar cost average system where now you can set up an automatic deposit where every month you keep investing more money into your real estate portfolio, because you can't do that with physical real estate, but Fundrise lets you do that, where now every month you can just keep building your portfolio bigger and bigger and bigger. This way now you can get more exposure to real estate, you can get some cash flow because they pay dividends as well, and then you can also grow the portfolio of your real estate balance as well. So if you want to learn more and see what type of real estate Fundrise is investing in, and you want to see the historical returns, I'll put the link to how you can learn more, get started, and start investing with Fundrise down in the description below. Now, if we look at the housing market today, where we saw this massive boom and now the demand for homes has been dropping like a rock, a lot of people have been comparing the 2008 financial crisis to the housing market today, and I don't think that's a very fair assessment, because you have to understand what 2008 did and what 2022 is doing, that we understand how they're different and how they're similar at the same time. So 2008, the whole financial market meltdown was triggered by the real estate market, the housing market. So the housing market started with these three things: the housing market bubble and bust. You had first ninja loans, which stood for no income, no job, no asset loans, meaning if you didn't have an income, you didn't have a job, you didn't have any assets, and you walked into the bank saying, I want a $200,000 loan to buy a home, they would say, no problem. You can get a home with 0% down. 0% down payments were very popular. In fact, they had some loans where you could get 110% loan to value loans, meaning if a home is $100,000, they wouldn't just give you 80 grand or 90 grand or 100 grand. They would give you $110,000 to cover your closing costs, to cover your move-in costs, because everybody thought home prices could never go down. So banks were literally giving you free money to go out and buy a home because everybody thought home prices could not go down. Then you had subprime mortgages as well, which was where you had a very low credit score. You should not have qualified for a mortgage, but banks were able to give you the subprime loans, meaning loans with a higher interest rate, and they were able to find ways to give you loans even though you shouldn't have gotten one. And then you had the adjustable rate mortgages, which is what we're seeing right now, which is where you would get a low teaser rate in the beginning. So you'd have a very low mortgage rate for the first few years, and then as interest rates went up, the mortgage rate readjusted, and then all of a sudden you were slapped with a much higher mortgage rate that you couldn't afford, and this get a lot of people in trouble. And then you had the Wall Street issue. The Wall Street issue was now banks were making all these mortgages, and everybody on Wall Street said, well, let's get in on the fun too. So then everybody on Wall Street started chopping up these mortgages, selling them as different investments and as different securities, and this went on and on and on. This created this huge domino effect, so that when the housing market started to fall because of these three things, then Wall Street essentially was on the verge of collapsing. But it started with the housing market. In 2022, our economic slowdown is not being caused by the housing market, it's being caused because of inflation. So a very different trigger. Yes, we have adjustable rate mortgages today. Nowhere near what we saw before the 2008 crash yet. However, adjustable rate mortgages are growing, and we do have, everything going on with Wall Street, but we do not have the subprime lending. We do not have the same ninja loans the way that we did before the 2008 crash. So what does this mean? Well, the economic issues today are different than the economic issues that led to the 2008 crash, because in 2008, it was the real estate bubble that triggered the dominoes into everything else. The worry today is that the inflation domino could trigger more dominoes to fall, because now with this whole inflation issue, we have the cost of everything so high. So people can't afford basic things. They can't afford the same lifestyle that they had a couple of years ago. They can't afford the same lifestyle they had a few years ago. And so inflation is starting to cool down the economy. And if that continues, and businesses start to slow down, businesses start to lay people off, that means that unemployment would also rise. And now, if we cannot get inflation under control, however, unemployment keeps rising, so people are losing their jobs, the price of things are high, people will not be able to pay their mortgages then. If people cannot pay their mortgages, well then that creates the next domino, which is the real estate market. So there's a lot of different things that you have to pay attention to. There's a lot of different factors, because right now you have some people are saying, oh, the real estate market is going to collapse just like 2008. Well, that's not how it works, because there's so many different factors. And then people say, oh, well, inflation is just going to get better because of the Fed. Well, maybe, maybe not. There's a lot of things that you have to pay attention to. But ultimately, if you want to get a direction of where the housing market is going, there's one thing that you have to pay attention to. And I talk about this a lot now, but you really want to pay attention to this, because the Fed is going to be the biggest determining factor as to what's going to happen with home prices, because everybody says, oh, home prices are going to correct. But that's not necessarily true, because if the Fed doesn't keep raising interest rates, well then home prices could crash upwards. So what this means is the Fed, the Federal Reserve Bank, is in charge of the monetary system. They can control interest rates. Right now, they are working to raise interest rates. The reason why is because when you raise interest rates, it's a way to fight inflation. It's a way to cool inflation down. And right now, at the time when we're making this video, inflation is the top priority for the Federal Reserve Bank. Now, this is their top priority because our economy, in the Fed's eyes, is still very strong, because people have jobs, because unemployment is low. And that might not stay the way that it is now. So if the Fed for the next few months continues to raise interest rates, but then the economy starts to slow down and unemployment starts to go up, well then the Fed might stop being so aggressive with the rate hikes. And this is something that you want to pay attention to, because jobs are kind of a lagging indicator, because the job market will take some time to adjust to what's going on in the economy, because businesses don't want to lay people off, right? They don't want to fire people. They don't want to let people go. They don't want to slow down their growth until they're forced to do so. Business owners, CEOs, they're not economists. They want to grow the business as fast as possible. So they're not trying to predict what's going to happen in the future. They're looking at the cash in their bank, and then they're saying, okay, what can we do to grow the business as fast as possible? So the biggest indicator that you want to pay attention to when it comes to the housing market is the Fed. If the Fed continues to raise interest rates for the next 6 to 12 months, you can expect home prices to start going down. However, if the Fed at some point, whether it's 6 months, whether it's 12 months, whether it's 18 months, the fight on inflation, if the fight on inflation doesn't completely get better, if inflation doesn't stay down at 2%, but the Fed says, okay, we've brought down inflation from 9% to a more manageable number, let's just say 5%, which is still extremely high. But then they say our bigger issue now is the unemployment. It's the economy. It's the asset prices falling. Well, then what the Fed may consider doing is cutting interest rates. Well, if they cut interest rates, that means mortgage rates would also go down. That means the housing market would then start booming again, because people may start going out and buying homes, trying to take advantage of the low mortgage rates again, because now it's a new influx of cash. This is why you cannot look at the housing market and just say, oh, because home prices are gone up, that home prices are going to go down. This is why I also say, don't try to time the housing market if you are a real estate investor, because we don't know what the Fed is going to do. Yes, there's a lot of uncertainty. Yeah, there's a lot of issues in our economy. However, if the Fed starts cutting interest rates, that could cause an upwards crash in asset prices, because that would create more inflation and more people will want to go out and buy homes. It would make it cheaper to buy this real estate. And so you don't want to try to time it, because if you're waiting for a crash and then it crashes upward, well, then you miss that opportunity. Likewise here, you just got to understand that if the Fed continues to fight at inflation, that means interest rates keep going up, home prices will eventually have to correct to make up for this higher cost of home ownership. So if there's anything you got out of this video, make it this. The Federal Reserve Bank is going to be the leading indicator of the direction of the housing market in the future. Now, the Fed and the housing market have a lag time because the housing market takes time to change prices. It takes time to adjust. But just understand that if the Fed continues to be aggressive on interest rates and inflation for the next 6 months to the next 12 months, you can expect home prices to correct. If the Fed reverses course, you can expect that that's going to change the trajectory of home prices, because if they start cutting interest rates, then home prices will continue to go up. So those are the things that you want to pay attention to when it comes to the housing market. If you enjoyed this video and you want to see what's actually going on with the everything bubble that's now starting to pop, I made a video going over this in depth, and you can watch that video by clicking this button right over there. Thank you for watching, and as always, keep hustling. We live in a credit-based economy.